Good morning, everybody. Morning. Hopefully you had a good long weekend. Hope you didn't eat too much chocolate. Sure the kids would have. Welcome to another Wealth Coffee Chat, team. Yeah, same to you guys. Chris, thanks, mate. Yeah, hope you guys had a great Easter too. It's nice to have a long weekend, isn't it? Bit of a break, chill out, do what you need to do. Great to see a few of you guys on this morning. Might be a bit slow and steady this morning. A few people are probably still on a bit of an extended break. I know a lot of people have been grabbing a few extra days and having an extra long weekend, or maybe a couple of weeks off, or 10 days off anyway between the public holidays. So great idea. Anyway, good morning to all of you guys. Like I said, welcome to another Wealth Coffee Chat. Hopefully you're all awesome and well. Quick intros. Jason Witten's my name, as most of you would know, but if you don't, if you're new, say hello. Let us know where you're dialing in from wherever the live world is bringing you in, Facebook or YouTube or other places. Give us a shout out. Let us know where you are in this wonderful world. Been property investing myself over 20 years, coaching property investors over 18, and each morning get together with the crew and have a little bit of a chat. We call it a Wealth Coffee Chat. And let's talk about what's going on in the marketplace. Now, hopefully, I'm just going to adjust my camera there to make sure it's in focus. Where were we? Intros. Yeah. So, listen, got a question for you. I chucked it in the headline today. 12% of Aussies have this thing in their mix, in their wealth mix. What do you guys think it is? 12%. Well, I say a few shout outs. Chuck it in the chat. What do you think that 12% of Australians are using as part of their wealth plan and the rest aren't? Team, tell me, what do you guys think it is? Morning to you, Chris and Bob and Barry, James, Allison, Adrian, Graham, Jimmy, Jeff, Alexis. Now, Facebook user, good morning to you. It's popping up because you're more than likely in our mentoring program or new to one of our groups, and it doesn't show your name, unfortunately, which is a bit of a bummer. But good to hear from you, dialing in from Western Sydney. Fantastic. Budrum for Teresa. Good to see. Oh, crypto, Graham. Oh, well, that'd be interesting, actually. I'd like to see the stats on that. It's not crypto or gold, Bob. Maybe something a bit more esoteric when it comes to the world of wealth plan. I think Nadine's getting a bit closer. Jay, how are you, mate? Good to see you there. I was thinking about you the other day, Jay. We should catch up sometime, Jay. Hopefully you're awesome and well, mate. Let's catch up for a bit of a yarn at some point. Andrew shares, I think. James is getting closer. Tax accountant. Listen, I'll put you out of your misery. Property and super. Actually, that's probably pretty close, actually, as we go. But according to some information floating around, that below 2 million Aussies have a financial advisor or have any sort of financial advice service in their wealth plan, which is a bit of a concern for many of us. Financial advice or financial advisor. Now, it doesn't have to be a financial advisor. In my world, a good wealth accountant, a good wealth advisor, business advisor sometimes, and financial advisor, sometimes they can all be packaged into one thing. This is the confusion, I think, that leads to not that many people using the world of financial advice. Now, I'm not going to go down that track this morning. I think financial advisors are really important. I think the government and the legislation is severely lacking when it comes to good financial advisors being able to work with their clients. The big companies have all the money to be able to do all the compliance and take some risks, where the smaller, more boutique, often more understanding and caring advisors, unfortunately, get priced out of the world of financial advising because of all the compliance malarkey. But anyway, we're not going to talk about that today. I want to talk about, why it's important to have this stuff in the mix, because, as we move through life, sadly or unfortunately, there's a lot of legislation, team. There's a lot of rules. There's a lot of things we need to navigate, and you need people who know what's going on when it comes to this world as we roll forward. So 100,000 people, according to this article, quit financial advice last year as advice fees increased. And it's an interesting conversation, this one, and I thought we'd sort of maybe just wax a bit of lyrical this morning about it. The idea that, so chuck it in the chat for me, team. Put it in the chat for me right now. In 15 or 20 years' time, many of you guys are in the mentoring program. What would be the expectation of your kind of gross wealth? What would your property portfolios be worth? And the income that it's producing, let's say in 15 or 20 years' time. What type of outcome are you looking to achieve? And maybe across all of your investing, just chuck it in the chat. Just put whatever number in there. This is just to give it a bit of a sanity check. For me and my family, our passive income, 100K a year, says Joel. Perfect, mate. And what would be your equity or your portfolio value? Probably $2 to $3 million. As you go along, right? So for us as investors, we have to think about, all right, well, if we're going to get some assistance, if we're going to get some advice, there we go, like $3.5 million. So if we're saying, all right, let's say in 20 years' time, I want to have, 3.5 mil, and I want 175 of income, and let's say over those years, there might be a fee attached to it, call it $3,500. Now, what would that look like when it comes to what would we invest to achieve $3.5 million safely, well-structured, low tax, passive income, et cetera, right? So it's an interesting question that many of us haven't really thought about. It's like, well, if you want that wealth outcome, what would you invest to get it? Okay, what would you invest, maybe annually, maybe once off, maybe multiple times along the way? And this is what I find we don't get the time to really comprehend and understand when we're sort of, down in the minutiae of our daily life. We've got someone there, $5 million, 200 grand yearly. Okay. So, which is fantastic. So, if you thought about it over 20 years, that would, let's say, cost $70,000. So if I said to you right now, I could wave a magic wand, and in 20 years' time, all you've got to do is give me $70,000 right now, and I'll wave a magic wand, and I'll give you $5 million and $200,000 a year. Like, who would take that deal? Right now, I'll wave a magic wand, and I'll go, abra, bloody cadabra, the Harry Potter movie, whatever it is. And away you go. You give me 70 grand and I'll give you $5 million portfolio and 200K a year. All right. So now that's very, basic thinking, but unless you had a problem, yes, please. Right. Unless you had a problem, like this is the thing, team. Right. And this, when you put it in perspective like that, it's like, well, yeah, that's a no-brainer. Why wouldn't I? That'd be a massive return, okay? And this is the challenge we face when it comes to rationalizing investing in our own wealth, investing in our future, because we look at the investment now as a cost now, but we don't extrapolate its value into the future. Like our mentoring program, like paying for a good tax accountant, like investing in a good financial planner, et cetera, et cetera. What is the compounding future value, not just the cost today? And that's a pretty important question. So what does it all look like? Right now, if you have a look at, Australia, and let's have a bit of a look at what's going on. The couple of ones that I want to point out just here as we sort of have our bit of a yarn. We've got 9.1 million households, and we've got 11.7 million, employed. Okay. And I think this might be a few years old, but I think the population of Australia is about 24, 25 million. So if we think about that right now, and we have a look at, I'm going to jump over here. If we have a look at the population, we've got 25 million people. Actually, we'll do it up here. This is pretty good. We've got 25 million people. And for the most part, pretty well, all of these people should be getting some sort of financial support, some financial advice, right? Of some description at a very minimum. And the challenge is, what does it mean? Do I have to invest heavily over that time, or does it change? And the answer is it changes, it's different. Let's just quickly do this. And this is, you would have seen this concept when Andy Fenton came along the other week and talked at our mentoring program. He was amazing. And did anyone catch Andy Fenton the other week at our mentoring program? Give us a shout out in the chat. So let's have a look at this. 18 to kind of, 30. 18 to 30. Actually, I think it was a bit different here. 18 to 45. So let me know if you caught. Yep, loved it. Perfect. So what Andy sort of says is, in this early stages, and we call this acquisition, consolidation, and lifestyle when it comes to our property investing portfolio. But, this part from 18 to 45, financial advice, when it comes to stuff outside of property investing, when it comes to our super and other things, what important things do we need when it comes to financial advice? Tell me right now, team, what are the things that are important to us as we move through these stages of our lives? All right. In this early stage, other than the acquiring of assets, when it comes to financial advice or good financial advising, especially when it comes to our super and other things, what are the important things when it comes to, this section? Now, Andy's world, and he talks about the idea of super and those sorts of things, is in this section, we can use good financial advice to understand how to protect ourselves and our family. Yep, structure. Yep, structure is good. Protection, the right structure. And tax efficiency. All right. So in this section here, absolutely, good foundation, structured correctly. So the idea, as we move through these stages, team, is that, each bit is often focused on a bit differently. All right. So, ages 18 to 45, we usually get married, we have children, buy a house, get jobs, probably have the most debt in our lives, et cetera, et cetera. And that's where sort of good insurances and good protection for you and your family is. How you structure that is super important. And if you do buy assets, what does it look like for the future? All right. In the consolidation stage, what is good financial advice for over here? Again, protection is in there. But Protection. But as we move into this section, we are looking at the idea of certainly how do we move our assets into the most tax-effective place. The idea that we've purchased things, we might want to start to use our super in a different way. You guys know the idea that our super is, the only. Well, tell me, the tax rate in the super in after 65. What's the tax rate from a capital gains tax and an income tax point of view, team? Tell me that right now in the chat. Now, this is not financial advice, by the way, because nobody knows your personal circumstance. If you need financial advice, you should seek out someone who's licensed and knows your personal circumstance, etc., etc. But this is just a conversation, and Chris nailed it, right? Here we go. It's 0 in this stage, and in the earlier stages, it's 15% and 10%. Okay, so it is a very tax-effective place to own some assets as we go along. So protection continues. Tax effectiveness is really important because we get to keep more of what we created. And this section here, team, is the most important section. This section here, as we enter the lifestyle phase, this is the section where you need the likes of, an Andy Fenton, Anthony Wolfenden, people that we know really well, to help you structure as we go along. Bob, someone who's a mentor, often team, you guys have heard me talk about the 6-star team. Often, these people are specialists in an overall plan. Okay, so when we talk about a good idea, a big wealth idea, who are the specialists that we might need, especially if it's property centric? You've got your mentor, your coach at the center, the person who's helping you create a property centric plan. And then who are these specialists that we need, right? The specialists are, firstly, often a good mortgage broker, someone who understands that. Then you need a good acquisitions or a buyer's agent, someone who goes and finds you awesome deals in all sorts of different places. You need a great property manager. Your property manager is going to be hanging out with your property for longer than you will ever. Then you need an awesome accountant, and then certainly a great financial planner. So you've got these 6 team members who are part of your wealth plan. But the world of financial advice and financial planning usually centers around things like insurances and super and some investing in some, shares and the share market. And we need to make sure that we understand which bit is for when. Anyway, hopefully that was all right. We just had a bit of a rambly chat this morning because I thought that was a really interesting article, folks. What would you be willing to invest to get your outcome? In 15 or 20 years' time, what would you be willing to invest? If you were there at 65 years old, looking at being on the pension and living off $18,000 a year, below the poverty line, what magic wand would you want to wave to create the financial wellness that you want at that point? Because I can tell you, $70,000 to $100,000 of investment over the next 10 to 20 years to get you $3, $4, $5 million worth of asset value and $150,000 to $250,000 worth of cash flow. Yeah, it's a good deal every single time. Every single time, team. Every single time. The challenge is we analyze the cost today, but we don't see the future value. And that's probably the conversation for today. Remember, the cost today is real. You've got to pay for it. But what is that future value, that compounding future value, the return into the future? Happy days. Cool, Adrian. Hopefully that landed for everyone listening in today. And that's right. Like often, Adrian, we only analyze the cost today, but not its value. Anyway, that's it. I'm just rambling a little bit now. Great to have you guys join me today. Looks like there's a few people on today. Maybe you guys are all having a bit of a rest. Hopefully you're not going to rush around too much. It's a bit of a short week this week. So enjoy the rest of your week, folks. Thanks for joining me on Tuesday the 19th. Join me tomorrow, Wednesday the 20th, for another Wealth Coffee Chat. All right. I think that's about it, team. You guys have a good one. Take care. Bye for now.